Great. Well, welcome everybody. I expect there'll be still a few more to come. My name is Andrew Lance. I'm the Chief Operating Officer at Simplicity, effectively standing in for Sam today. And as I say, I'm not surprised. The first question was, where is Sam? Sam's taken well-deserved leave. He left before this all really kicked off. So he's hiding away and still having a bit of input with us, but we felt it was not fair to drag him out of holiday to come online. We thought what we would do instead is just have as long a session as it needs, up to about an hour, just to answer any questions our members and others may have. And so please feel free. In terms of housekeeping, if you could keep your questions, if you're on Facebook, your questions will be passed across to us. There's a Q&A button at the bottom of the screen. If you could put any questions in there rather than the chat, because it gets quite difficult to monitor the two. Beyond that, as I say, I'm Andrew Lance. Simplicity has been going for just over 5 years now. We have $4 and a bit billion of funds under management. It's varying a lot at the moment with markets moving around as much as they are. But we're very happy with, as I say, passing the 5-year threshold and default status now, which has been great. So thank you for everybody that's supported us to now. And again, the idea of this presentation is really just to answer any questions you have and hopefully reassure you that we've got a vague idea what's going on, put it mildly. So clearly the last few days and weeks have created a lot of uncertainty. And as we said in the email that we sent out yesterday or the day before, uncertainty unnerves financial markets, and they don't like it. They'll tend to move around quite a lot, as we've seen over the last few days. But it's just another one of the very almost 5-yearly events that seem to happen to markets. We don't want to sort of make any suggestion that this is not a major event. Russia invading another country is clearly extremely unsettling, but the sun does come up tomorrow, and this will dissipate over time. Who knows exactly what's going to happen, but we are comfortable that over the very long term, and long term being 5 to 10 to 12 to 15 years, financial markets, particularly share markets, they go up. They do go up because they reflect economic growth. And given bad times occasionally from various different reasons, and social unrest or political unrest is one of those, over an extended period of time, financial markets do go better. So we'll try and address, as I say, the questions you have as best we can. I've introduced at this point Ian Miller, who's our head of wholesale and who will help me along the way. He's got a great deal of experience in markets as well. And so between us, we'll try and cover everything that we can.
Yeah, thanks, Andrew. And there were a number of questions submitted online earlier. And they probably fall into the same sort of 3 or 4 categories that we'd expect. It's a little bit about Russia, it's a lot about inflation, lots of questions about fixed interest and bonds. But I thought perhaps if I just tackle the first few of those to get us going, is that going to be okay?
Sounds right.
Fantastic. So the first question I've got here was from George. Essentially, I want to invest in a fund that's passive and low cost, ethical, tax efficient, and follows an index. And I have a long time horizon, 20 years plus. Your growth fund would be perfect, but it simply has, I'm paraphrasing the question, but simply has too much in fixed interest and cash. When can we have a higher exposure to stock product, which you don't offer? And that's from George.
Right, and thank you, George. I mean, it's a really good question. It's one we've been asked quite a lot over the 5 years, in fact, that we've been in operation. When we set the business up, we aim to mirror the 3 major categories of KiwiSaver funds as they were at that stage, which was conservative, balanced, and growth. And we felt that really growth at roughly 20% bonds, 80% shares was sufficiently exposed to growth assets, shares, etc. We're reviewing it. It is, you're absolutely right. If you do have a 20-year time horizon, it probably does make sense, but it does, for the majority of people, the sort of ride that you get having 100% involvement in share markets can be a little more uncomfortable than they're happy with. And what we don't want is to create a product that people switch in and out of a lot, because that's not really behavior that helps in the long term. So it's under review. It's something we're still thinking about, but at this stage, we're not planning on it.
Thanks, Andrew. Next one here is from Peter. We understand that the supply chain problems with COVID has pushed inflationary pressures. Do you think this is transitory or now well and truly embedded? And if so, what's the impact of rising prices on our funds?
Yeah, extremely topical, obviously. There are some key points here, and we have to be very careful. We don't know is the short answer. But our view is that the key point here is really almost a consumer-led thing, in the sense that, do people believe that in future they need to spend their money today because tomorrow the prices might go up, and it's known as inflationary expectations. So if people start pricing in the idea that they need to spend all their money today because tomorrow prices are going to be higher, then that would suggest that the inflationary pressures will just keep building, because all that happens is obviously that you just exacerbate the problem. We don't believe that to be the case as yet. Yes, supply chain issues have caused higher prices. The rise in petrol prices, which is coming through thanks to the situation in Ukraine, is not going to help as well. Obviously, in New Zealand particularly, house prices have gone up quite sharply over the last year or two. But as I say, my view, it's probably slightly personal to it, is that inflation is not entrenched yet. People still expect their next iPhone to have a higher spec than the one that they paid exactly the same for last year. They expect to pay less for TVs, or buy the latest one, which is the same price as the one previous year. And as long as technology is continuing to keep that pressure on the quality of goods, then actually inflation is not it will not take hold in the way that it could. Central banks are moving to try and control things by slowing down economic growth effectively by increasing interest rates. And it remains to be seen how effective that will be. But it probably feeds into a question I suspect we're going to get as well, in that New Zealand as a whole, we are all pretty highly geared relative to most countries in the world. And therefore, a relatively small rise in mortgage rates is likely to cause quite a lot of tightening on people's personal balance sheets. So that then would suggest that, as I say, interest rates won't have to rise so much to slow down the increase and so on. And although it might be a little bit painful for a while, hopefully that will keep inflation under control.
Thanks, Andrew. Actually, that's very close to the question from Mary C, which was essentially, what does all this mean for recent first home buyers? Are we going to face increased mortgage repayment costs and see increasing mortgage defaults? So I mean, increased defaults is an interesting one too, because we pay our mortgage. We make sure we pay our mortgage, and you pull your belt in elsewhere before you default on something like that. It would take, it seems to me, it would take something fairly dramatic for it to really undermine the housing market, therefore cause defaults. But I mean, in the worst case scenario, I'm sure that could happen. We just try to take a slightly more optimistic tone to things, and that as I say, the first reaction from consumers is going to be to tighten their belt, which will slow down spending on other things, but will allow them to maintain their mortgage payments. And again, if that is the case, and the Reserve Bank can see that's what's going on, then it will. They won't need to put interest rates up quite as much as they're currently forecasting. Thanks, Andrew. And now, apologies to everyone. I've just had to aggregate a number of these questions, but they're all along the same theme, please. So first, essentially, why are we holding Russian bonds, and when will we exit those? Or do the banking sanctions mean that you can't? Sorry, that's the thrust of the number of questions there, Andrew.
I mean, I guess from my point of view, the very disappointing thing to say first off is that we still do hold, I think we've got 6 Russian government bonds. They're held within a portfolio that's managed by Vanguard, so we don't directly control it. Now, I've had conversations with them already, and we've made our position very clear that we expect those to go, and I'm confident that they will, but right here, right now, I can't say that they have. In terms of, there are some somewhat sort of strange circumstances here in a way. Because of all this, Russian debt has just lost its investment grade rating by Standard & Poor's, which would mean it would fall out of the index that we monitor anyway. And the other thing, which is somewhat more ironic, is that the Russian bonds have fallen to such an extent that where they represented, I think, 0.19% of our portfolio before we went into all this, it would now be considerably lower than that, because nobody wants to hold these things. Actually selling them will probably be quite a problem for Vanguard. And that alludes to the same thing you mentioned there, Ian. It's part of the question. The sanctions on the financial sanctions on Russia, I think, are probably going to take will cause them real problems, because they are indebted, not anywhere near as much as they used to be, but they are indebted, and the ruble's fallen through the floor. So from an economic point of view, this could be quite damaging for Russia, which is obviously what they're intended for. But yeah, suffice to say, we will be getting out of the very few little Russian holdings we have as quickly as we possibly can.
Thanks, Andrew. There's a great question, Tony. Bonds lose value when interest rates rise and term deposits hold their value. New investments paying higher returns. Do you put money into term investments as a diversifying offset to bonds?
Yeah, it is a good question, and there's an element of the two being virtually the same in a way, because bonds have the same characteristics as term deposits. It's just that they're revalued every day, whereas a term deposit, you put your money in and you just get your money back at the end of it all. If you bought a bond and didn't revalue it, that's exactly what you would get for whatever time the bond was up for. So yes, you put your money in term deposits, but then if interest rates rise, you could have put your money in at a higher rate. And so the one that you had at 1.5, where you could have got 2.5, you don't feel particularly good about the 1.5. You still get your money back at the end, but you could have got 2.5. Well, bonds revalue the whole time. So the 1.5 gets revalued such that it looks like you can now get 2.5 out of it. That doesn't make a lot of sense, but it's a sort of mathematical thing. But fundamentally, the only difference between term deposits and bonds is that, as I say, the bonds are revalued every day. Your term deposit, you don't revalue. So no is the short answer. Putting money into term investments simply just means you don't get that revaluation. All you do is hide it effectively.
Yeah, thanks. I'll just jump to one from Warwick, because that's sort of along a similar theme. Warwick, so I need to withdraw some of my money from the conservative KiwiSaver in 5 or 6 months. And given the interest rate risk, should I withdraw that now?
And unfortunately, this sort of feeds into that catch-all that we have to say the whole time. We can't give you financial advice, and essentially we don't know. That sort of time frame for an investment horizon is actually very short. And so if you to be honest, for mine, you probably want to do sooner rather than later. It sort of feeds into, again, a broader point, and that is that the growth fund and even the balance fund, they're designed for 7, 8, 9, 10 years time horizon at least. And you need to try and make sure you're in the right fund before you start, and then you stick with it. You don't keep moving around. There's a really good piece to support the letter we sent around on Monday night. Really worth a read, just as I say, to get it from somebody very independent, just to see the way they look at things. And it's the same piece of advice that we give the whole time, which is broad, and that is simply decide what fund suits your time horizon, whether it's 5, 7, 10 or more years, and sit with it and hold.
Thanks, Andrew. This is a slight diversion on theme, but how's Simplicity Home Loans going? And are people repaying on time? Are there any repossessions? Are we able to fulfill our business plan?
Great. So far, everything's ticking along pretty well. Obviously, there's a bit of discomfort with the fact we've had to put interest rates up a couple of times from their low point, but everything's ticking along well. One of the reasons we feel reasonably comfortable with our borrowers is because we insist on quite a high level of income to service interest rates when they take out the loan. And that should, as I said earlier, give them enough room to tighten their belt. And the question will come, of course, again, if interest rates keep going up, how long will that last? But at this stage, and we're certainly fulfilling the question about business plans, we never expected this to grow rapidly because our lending criteria are quite tight. They're only to first-time buyers. They're only our members. But it's probably grown about exactly as we would have hoped, and we're thrilled with how well it's gone.
Exactly, thank you. And John's got a quite a strong view here. Can we dump any Russian stocks, and question why, given the 2014 invasion of Crimea, we have any investments in Russia? He has some in the Simplicity list, and he's very unhappy that they've funded the government there.
Yeah, understandable. And it's easy for us to hide behind the fact that we invest in, as I say, in a Vanguard fund, and essentially the rules on what's included in the Vanguard fund are set by another third party who create the index that they follow. So that decision needed to have been made by an entity that we've had no direct involvement with. It's very small. I mean, I take what you say about Crimea. There wasn't quite the uproar that there is about the way that Russia has approached Ukraine, and it will be going. But I broadly agree with you, and it's disappointing. And as I've said, that I've made that point very strongly to Vanguard already. I think any index that claims to be ethically conscious should have exited these immediately. So as I say, that point's been made, and I'm confident that it will be followed up very soon.
Work in progress. Work in progress. Sandra has the best question of the day. If we were in a room, I'd give you a T-shirt. Be fearful when others are greedy, and be greedy when others are fearful. The question, though, is now a good time to switch to higher risk investments, Andrew?
Oh, yeah, great question. Yeah, possibly. We don't know. We can't give you any advice. But certainly the last few days, markets have sold off quite sharply. In the longer term, this still looks like a blip. And the sell-off that we got when we first reacted to COVID is nothing. It was far, far greater than we've seen so far here. So timing is everything. From my point of view, long-term investors should look at this as an opportunity to buy into growth assets at a lower price than they would have had 2 weeks ago. And if you're drip feeding your money in through KiwiSaver or even through your investment funds, then it's working nicely for you. But it's just very uncomfortable in the short term. As to whether it now would be the time to switch in, I'm afraid only time will tell.
Thank you. And can I just remind people, if you are posting questions, we've got some from Facebook and some from here, but the Q&A button at the bottom of the screen is the easiest way for us to be able to work our way through rather than the chat function, if that's okay. Next one, Andrew, isn't really a question, it's a statement. Bitcoin is the statement.
Oh, I love it. I think our view on crypto is essentially that the technology is tremendous and has a lot of place, but the valuation of cryptocurrencies is a little bit more difficult to justify. And interestingly, over the course of the last 3 or 4 days, there's been very different views on how cryptocurrencies fit into what's going on in Russia. Because on one hand, you'd say that that's a great place for these Russian oligarchs to hide their money. But from another point of view, that puts them greater in the scrutiny of the global regulators to say they don't want that to happen. And if the global regulators try to get involved in cryptocurrency, that takes away their apparent attraction. So very moot point, could be a very interesting few weeks for cryptocurrencies in that respect. But our overall view is that until that market is more regulated, we don't feel comfortable investing in it.
All right, thanks, Andrew. And one from Warwick. I think this is why are the unit, so either why or when are the unit prices been updated? Now, I'm pretty sure that there was a failure yesterday in the update from MMC, our administrator. So if it's about why aren't they being updated, all that will be resolved this afternoon. So you'll be able to, all those updates will flow through. One from John, any plans for a cash fund? Would like.
Yeah, that's absolutely, and obviously that's the opposite end of the scale from an aggressive fund. We've, I better not steal Sam's thunder on this one, but we are actively looking at some ideas to create something more akin to a cash type investment than the conservative fund or the bond fund, because we can absolutely see that there is a potentially quite a sizable demand for that type of investment, and to a degree that's the reason we've got involved in the build to rent initiative along with the mortgage fund, to try and find ways of generating more stable cash flow for our investors. So yeah, I guess there's an element of watch this space there too.
I think actually that flows really nicely. There's a Facebook question from Anne talking about the investments both in the first home mortgages and funds in the build to rent. Is it clear what percentage of each of those funds is earmarked for that? Anne loves both of these schemes for social justice purposes, but would just like a little bit more detail around how much of those funds are going to be invested in those two things.
Sure, and at the moment, so for the mortgage fund is predominantly the conservative funds have most of their investments in that fund relative to the others. So there's more in conservative, a little bit less in balanced, and even less in the growth fund. In regards to the build to rent, and the percentages are sort of 5 or 6% in conservative, down to 2 or 3, down to not much in growth for the mortgages. For the build to rent projects, at this stage, those are only invested in by the balance fund and the growth fund. But that's because we're still in it's tiny right here, right now as a percentage, but also because during the, let's call it the development phase, the perception is that there is some risk to those investments. We're very comfortable with the constraints we put on those risks, but there are some risks. So until we've actually got property which is actually generating rent and is therefore genuine bricks and mortar investments, the investments will be in the balance and the conservative fund. Once we've got some housing stock built up, then we are envisaging that we will be able to move the conservative fund more into that investment. That's subject to agreement with our supervisor, Public Trust, but we're all very comfortable that once we're talking about physical properties and rental income, that's a very different investment than the development phase which we're in at the moment. I hope that makes sense.
Yeah, and Andrew, we won't hold you to it, but when are we expecting the first finished property to be rented?
End of this year, I hope.
Yeah.
Early next year at the latest.
Fantastic. So hope that helped, Anne. We've got one here from Mark. We've had a windfall and have a significant amount of money to invest and will not need to touch it for 3 to 4 years. with the short-term volatility we've seen in the last 8 weeks, golly, you could probably say 8 months there, but over the last 8 weeks, how do you feel about investing in your growth fund at present?
Again, same old caveats that we can't give you advice, of course. And again, I would direct you to that FMA piece too, because they also talk about what you do with lump sums. And they very much follow my view on this. Which of our 3 options you invest in, if it really is only a sort of 3 to 5 year time horizon, really you should be looking at those recommended minimum timeframes, and the conservative fund is down at that level. But even then, you've still got the problem of which day of the week do you put the money in. And I like the FMA's suggestion, which is what I've always thought, is to do it over a period of time. Break the funds up into blocks, and to a degree, depending on how often you want to transact and how conservative you are, make them smaller and smaller and spread it over more time. But fundamentally, don't put it all in at once, because you just never know on any one day. But if you are drip feeding over even a couple of months, even 4 or 5 weeks, you will at least get some benefit of averaging out the value that you actually invest at.
Thanks, Andrew. Here's one from Anonymous, but how's the falling New Zealand dollar affected the growth fund?
Yeah, so when the New Zealand dollar falls, if you've got unhedged investments, that's actually to your benefit. So only a portion of the investments we hold are hedged. If you hedge the New Zealand dollar and it falls, you unfortunately get the impact of that. It hasn't been the most currency hasn't been the biggest single influence on the portfolios at all. The share market has been by far the biggest influence over particularly the last 2 or 3 weeks. And the New Zealand dollar's held up relatively well. It's almost seen as unusually slightly less risky, because of course we don't have any exposure we have very limited exposure to Central Europe. So so far, and also our interest rates are generally higher than most other developed nations. So the New Zealand dollar, as I say, it will have had some impacts on some parts of the portfolio. It will actually have been slightly positive, but overall, the outright move in share markets is by far the biggest influence.
Thank you. Sorry, I'm just trying to type a message to someone because it's very noisy out there.
Yes.
Is it better to invest 100,000 into one fund, or to split it 50-50 between balanced and conservative? That's actually quite a good question.
Yeah, it is. It absolutely is. And to a degree, splitting it between conservative and balanced, all that does is gives you a slightly different mix. You end up with a sort of moderate balanced or an aggressive conservative, because the conservative fund and the balanced fund are both invested in exactly the same investments, just to different proportions. So there are more bonds in the conservative fund. There are slightly less bonds and more shares in the balanced fund. And so if you split the two, what you're doing is getting a sort of hybrid of the two. It really depends on your personal preference, but as I say, you're not increasing your diversification, because you're getting exactly the same investments, just in a different mix.
Thanks, Andrew. And I solved the noise problem. The team were trying to broadcast your presentation, and so I was getting feedback and echoes. Apologies if that's flowed through. It's a good one from Brendan. How easy will it be to liquidate Russian holdings? Everyone's trying to sell. Is it just cents in the dollar now on previous assets, or do you just write them off? What's the plan? Very much the latter, because everybody is basically trying to gradually do the same thing. They were very lowly rated debt in the first place, and now, as I say, they've become junk. Plus, so I'll make a very, very sort of broad point here, is that the bonds we hold, that selling out of them is not going to make any difference to Russia at all, unfortunately. The key is that they're not going to be able to raise any more money. So what would be awful would be if we were saying, oh, we're actually participating in an auction of Russian government debt. So the money that we bought originally,
that will possibly have gone to the Russian government, but they've got that. We can't take it away from them. And the value of what we hold now will have gone down dramatically, as you rightly say. So the liquidation of these things will be difficult. There's always somebody out there that's trying to take a contrary view of things. So I'm sure there will be a few buyers around, but it will be difficult.
I think last time I saw, Andrew, I think they were offering 25% or something. So
the risk of default now for Russia, I haven't seen the number today, but it was up over 50% yesterday.
And they have defaulted before, I think. So here's one from Sergio. What Vanguard fund is most closely related to Simplicity Growth? And he suggested the VTSAX, but that's not the fund we use, is it?
No, it's called the Ethically Conscious International Share Index Fund. It's you can find it if you go into the Vanguard Australia wholesale product suite. It's an Australian unit trust, and if you click on shares and international, you'll see the list there. And we actually hold units in. There's one that's in New Zealand dollar hedged and one that's unhedged. We hold some units in both of those. They're both invested again in exactly the same companies, but just with a slightly different currency approach.
Thanks, Andrew. Another one from Facebook. This is from Victoria. Awesome live stream. Thanks, Victoria. Thanks, team. Do you think it's good to have half your investments in a balanced and the other half in growth? What are the advantages of that?
So the same as the previous answer, in that what you'll end up with a sort of hybrid between the two. The balanced fund and the growth fund, much like the conservative fund, they all invest in the same things. The only thing that you'll get slightly differently in the balanced and growth fund will be, at this stage, a very small investment in the build to rent strategy, but that will grow in time. But similarly, so as I said before, the first home mortgage fund has got quite a bit in conservative, a little bit in balance, and not much in growth. So if you split between the two, you end up with somewhere in between, not a lot and a little. Similarly, international shares is quite a big proportion of the growth fund, lesser proportion of the balanced fund. When you combine the two, you'll get something slightly in between, so a sort of hybrid mix. But you're still investing in the same underlying assets, so you're getting the same shares, same bonds.
Nice, thanks, Andrew. This is a bit of a tough one. If the Russian invasion to Ukraine drags on, what kind of impact to our investments will be in terms of European markets and overall investments as a whole? Some are rather fearful this may turn into World War III. Any comments on that?
Yeah, I guess some of these things become quite personal, don't they? I don't know, in your view, how irrational or not is Mr. Putin? How likely would it be that NATO gets directly involved? What would Europe commit if that were the case? You really like to think that common sense prevails, because you can only imagine how dreadful it would be if those two big sort of war machines actually did start engaging with each other openly. It would be just too difficult to imagine. We countenance the idea that people could be so stupid as to really go into that they're in, and I can see that everybody's trying to provide them as much support as they possibly can without open warfare, and I just sincerely hope it doesn't come to that. But as I say, in terms, and so to the real question, impact on our investments. Yeah, if Europe went to war, it would clearly be a big issue for us. We've got a decent amount of exposure to companies and countries in that block, but this is where the benefit of diversification hopefully comes to the fore, because we've spread our investments as widely as we possibly can. We don't have a concentration of any of those entities, and the companies we invest in, we've got small amounts of everybody. So these things, I mean, as we've seen with COVID, these things are a benefit to some and a negative to others. And overall, the share market's generally gone up. Same with the situation in Europe, which, as I say, sincerely hope doesn't escalate further in that respect. We also have investments spread across Asia, across the States, South America, to try and diversify ourselves away from the risk of any one spot getting into trouble, which would be the case if that awful outcome happened.
Yeah, and look, there's some interesting research that's been done on conflict and the effect on markets, and the extent to which the pre-conflict nerves drive most of the activity, and then once conflict is in play, the amount of time that it takes markets to recover. But quite a good one was put out by Reuters yesterday. If anybody's interested, just to see those their views on that. I think State Street put them out as well. But it's an interesting Google event. There we go. So from Marcus, can you give us some insight into how you invest with a conscience? How easy is it to stay on top of all the businesses and governments who may be operating in a way that leads you not to invest in them?
Is that we to a degree, we outsource the management of our non-New Zealand holdings to Vanguard, and we expect them to be diligent in terms of monitoring those sort of events. They, in their own way, use what's called an index provider to overlay the ethical or the ethical screen that is required on all of those investments, and so we and Vanguard are reliant on them to maintain those screens. And the difficulty comes twofold. Firstly, just simple timing. I mean, I don't like the fact that we hold any Russian bonds at all, but I can't sell them. I've just got to tell Vanguard to sell them, and Vanguard have to talk to the index provider to say these shouldn't be in the index. Why are they in the index? And that takes time. And it's the same with any of these things. We've had situations where we've had investments in a company which, on the face of it, shouldn't be included in the portfolio, but for whatever reason, the index provider has found a screen that says, actually, no, they're not producing palm oil, they're doing something else. And you have to have some dialogue with them to actually get them excluded from your portfolio. So to a degree, we rely on our wonderful investors too. If they pick up anything, I mean, hopefully you know that you can see every investment you've got in Where in the World Is Our Money through our login. And if you see something on there you're not happy with, let us know, because we can have that engagement, and we do. And so if there is anything that we miss, or that Vanguard miss, or the index provider misses, please let us know.
Thanks, Andrew. Now, this is definitely one for you. It's sorry, I just need to find it. This is going to the dark arts of the world of international tax. Can you explain the tax efficiency of your funds in terms of slippage? There's been a suggestion that despite the low cost of the funds, they're not as tax efficient as other funds. That's probably enough to get this. It's quite a complex question. But to what effect does this affect returns, essentially? Yeah,
and this has come up before, and we are aware of it. It's something which we're actively looking at. But essentially, because we use these Australian unit trusts, there is some international tax that can get lost by us, because we can't get rebates for that tax passed through to us in New Zealand, because we're investing in an Australian vehicle. That, in a nutshell, is the problem. The actual amount of the problem is quite difficult to quantify, and estimates range quite broadly. And of course, it only applies to mainly applies to international shares, to a lesser extent Australian equities, but mainly to international shares. So depending on what fund you're in, it has a lesser or greater effect. But even then, once you trying to work out the quantum, one of the reasons that it's difficult to calculate is because there's at least 3 different areas that this relates to. So we've been engaging with some tax experts. We've been engaging with Vanguard to try and work out the best way for us to get a more tax efficient option. And as we've grown in size, so our options are beginning to become a little bit more palatable from a cost point of view. Up to this point, our overall view has been that by keeping our fees and the fees in the funds as low as we possibly can, there might be a little bit of tax slippage, but any benefit of moving that money into New Zealand would be more than offset by the costs, the additional costs of managing it from here. We're beginning to get to the point that we can look at that seriously. So that's a long-winded way of saying it's something we are aware of and we're working on, and we're able to hopefully find a solution to in the more recent future.
Nice. Thanks, Andrew. Sorry, I'm just losing my way here. Oh, are Vanguards using positive screening or passive? From Dick.
They're negative screens. So they exclude the likes of, take the easy ones. A weapons manufacturer is excluded from the portfolios. They're not looking for, they don't just pick companies that are doing something ecologically positive or somebody that's trying to limit carbon emissions as an investment. So as a passive investor, it's very difficult to do anything like positive screening because it's far more difficult to work out what you include than taking a negative screen and deciding you don't want to invest in stuff that's clearly bad, like weapons, like nuclear, like fossil fuels. Those are much easier to exclude just from a practical or operational point of view. So we don't positive screen, we negative screen.
And this is the question of the day. In fact, Sergi, I think if you could send me an email to info@simplicity and say, Ian said to contact me, I've got a prize for you. However, there are plenty of comments online suggesting both Vanguard and BlackRock are some kind of evil entities controlling the world. How do you refute such accusations aside from trying to educate people on what index funds are?
Yeah.
Perhaps you might want to remind them that Vanguard's probably one of the biggest charities in the world.
Yeah, that's right. I mean, and Vanguard are a mutual fund, so essentially they're the same as us. They're not for profit. They just have spent I can't remember quite exactly how long they've been going, but they've spent their time reducing their fees. That's been their goal throughout. I don't actually know a lot about BlackRock. I had some dialogue with them over the years, but have no reason to doubt their integrity. In both cases, the reason for them appearing to be somehow demigods or whatever is just the size that they've got to. And the reason for that is because the way that they invest money is proven to be advantageous over the alternatives, and that is active investing. Generally, over a long period of time, is proven to be secondary to passive investing. Now, everybody will dispute that, and we can all find studies to argue about whether that's the case or not. But fundamentally, in our opinion, you get better value for money by just investing in everything than trying to pick winners and losers and paying people a lot of money to do that. And that's why BlackRock and Vanguard have got to the size that they are, because that strategy is proven to be correct. And again, there's arguments across the board coming from different points of view as to whether that's good or bad for the world. But fundamentally, the money is still getting invested in the market. It is going across a broader spectrum of companies, and over time, good companies do well. So I find it slightly humorous when you actually get to know the people that you're dealing with, to the idea that somehow Vanguard is some devil. That's not their approach to the world at all.
Actually, just as a supplementary, they do quite a lot of work in terms of stewardship, Andrew. We haven't had a question on that for a long time, but it's just appropriate given that last conversation. Yeah.
I mean, and increasingly, it's interesting, again, looking at the fund managers around the world, and this whole business of being of stewardship, of being actually actively involved in the companies that you invest in. Historically, the likes of Vanguard and BlackRock were criticised for not doing so. For they wouldn't vote at AGMs. They would have no involvement in company activity at all. And they felt early on that as a passive investor, that was appropriate. But as time's gone on and as attitudes have changed, gradually their stewardship report, which comes out every year now, their engagement with company directors, company boards at AGMs is escalating rapidly. And I met the chap responsible for that department, and he's gone from being a side office somewhere to now having a decent sized department, and they're increasing globally. Saying that, they've still got a long way to go. If you look at some of the big European managers, their engagement with their companies is way ahead of where Vanguard and BlackRock are. So it's a developing thing within that industry, but yeah, they're far more active than they used to be, to put it mildly.
There we go. Thanks, Andrew. Here's one from Maria Josie. Is it a good time to open a growth fund if you intend to keep it for 10 years?
It's always a good time to open a growth fund if you're going to keep it for 10 years. Oh, that wasn't advice, by the way. But if that is your time horizon, then as I said earlier, I personally would be spreading out my investment over a period of time. But provided you've got at least that 10-year time horizon, then our recommended minimum time frame is 10 years for the growth fund, which therefore would say yes.
Right now, I've set a signal, Andrew, that says I've missed a couple of questions in chat, and I'm frantically searching to see where I have done that, and I can't. So absent that, I think we've just about got to the end of those.
Well, there's one there from Erica on the chat. Yes, the Ukraine invasion is one thing. What about the decline in Pfizer and Moderna stocks? Which is a good question. And funny enough, almost inevitable when you think it through, because they did so well from the beginning of COVID, and now the world is beginning to come out the other side. So the big advances they had, I don't know the details particularly, but I can strongly suspect that the reason that they're not doing quite as well as they were is because they no longer have companies investing so heavily in the medicines that they produce. For that, there is an affordable home one there, Ian, if you want me to just cover that.
Yes, thank you.
Any further plans on our to build 10,000 affordable homes? Do you plan to build to a green rating scheme like Homestar Passions? That's a bit too detailed for me, Jonathan, but the short answer is yes. Affordable homes is an interesting way of describing them. The idea is that we want to build long-term rental stock, which is a viable alternative effectively to buying a house. So you don't have to own your house. You can invest in something else and rent from us for a long period of time in really good quality housing. As to whether Homestar or Passivus ratings are going to be taken, I haven't got to that level of detail in discussion with the principals yet, but what I do know is that the homes they build are extremely good in terms of the insulation. I mean, you almost don't need a heater. You don't need a heat pump, and you don't need a heater. You don't need to cool them or heat them. They're very, very good in both summer and winter. But in terms of actually those sort of details, I wouldn't have that level of detail, I'm afraid.
Now, a number of people pointed me to this one at the bottom there. Excuse me, we've just been discussing ethical investing. Ethical requires paying our taxes. Come on, guys, step up. So I'm not actually quite sure what that's in reference to. Andrew?
Well, I certainly pay my taxes. No, I'm not really sure. I mean, if we're talking about that whole international equity piece, which is fair enough, the reality is that we're we're paying our taxes. It's just we're not getting the benefit of the agreements that you have with, for example, the British, and if they take tax off interest payments, there is an agreement between New Zealand and the UK, I'm pretty certain, that means that we can offset those taxes against any taxes that we pay here. And those are the sort of things we're talking about. So it's not that we're not paying tax, we're just paying tax in New Zealand and not double taxing.
So yeah, in essence, there are double tax treaties between many, many countries around the world so that you don't end up paying tax twice is more the issue.
But Sandra, if you mean something else, then let us know.
Thank you. I'm still just working through the chat there, Andrew. I think we've got most of them. Any further news on the plan to build 10,000 affordable homes? Do you plan to build green rating schemes? I think we've done that. Or
yeah, the other comment I would make on the 10,000 affordable homes is that's a very much long-term aspiration. Initially, we're talking about hundreds and maybe working towards thousands. It'll be quite a while before we own 10,000.
Nice. Message here from Sandra. Thanks for feedback. I shall proceed with some purchases I've been considering. Wish me luck. P.S. I already switched my KiwiSaver based on your excellent app. Oh, thank you. Actually, I hope everybody likes the new look of the website as well. Right, there we go, Andrew. It's 7 minutes to. It's just about an hour. I think you can do a gentlemanly wrap up and thank everyone.
Well, very much so. No, really appreciate your questions, everybody, and we're keen to do this as often as people feel we need to. So we'll do that. I mean, as I said earlier, we're not trying for any second to make less of what's going on in Europe. We're as shocked by it as everybody else, and we really feel for the Ukrainian people. And hope that this does not escalate into anything worse than it has already.
Absolutely. And thanks for spending some time with us at a lunchtime on a Wednesday. Any questions, info@simplicity.kiwi. The team's always, it's amazing how much, if they don't know something, they know where to find something. So, stay in touch, and we'll all say thanks very much to Craig Simpson, who runs that customer service centre. Outstanding.
Great.
Good to go.
I think so. Thanks very much,
everybody.